Hello, I'm Vidya, your tutor. Let's learn financial statements. Together, step by step. Welcome, I am Vidya. At the year end, every business prepares financial statements to know its results and position. In this chapter, we study the trading account, the profit and loss account, and the balance sheet for a sole trader. Before preparing statements, we separate capital and revenue items. Capital expenditure gives benefit for many years, like buying machinery. Revenue expenditure benefits 1 year, like rent. Wrong classification distorts both profit and the balance sheet. The trading account shows the gross profit or gross loss from buying and selling goods. We compare net sales with the cost of goods sold, which includes opening stock plus purchases plus direct expenses, less closing stock. Suppose net sales are 80,000 rupees and the cost of goods sold is 55,000. Gross profit equals sales minus cost of goods sold, that is 80,000 minus 55,000, giving a gross profit of 25,000 rupees. The profit and loss account begins with the gross profit brought from the trading account. From it, we subtract indirect expenses like salaries, rent, and depreciation, and add other incomes. The result is the net profit or net loss for the year. The balance sheet is a statement, not an account, that shows the financial position on a particular date. It lists assets on one side and liabilities with capital on the other. Because the accounting equation holds, the two sides always balance. To recap, classify capital and revenue items first. The trading account gives gross profit, the profit and loss account gives net profit, and the balance sheet shows financial position with assets equal to liabilities plus capital. Together they form the final accounts. Great work! Keep learning with Vidya and visit CBSETest.com for free lessons, worked examples, and practice tests.